Hello, Stephen Koukoulas here, Economist-in-Residence for the good folk at Zagga, and this regular update on the economy is including a range of really interesting things that are playing out. Now, we obviously recently had the Reserve Bank leaving rates on hold for the second consecutive meeting. Of course, the RBA governor is still worried about inflation being too high. However, and a very important however, she noted that the economy has probably softened. Certainly household spending has softened a little bit more than they were thinking. The unemployment rate has increased a little more than they were thinking. And of course, the June quarter inflation numbers, which were released just recently, were below what they were thinking. So in very simple terms, if you want to just sort of boil it down to what the RBA is thinking, unemployment being higher than expected, inflation being lower than expected, well, that leads to the on-hold decision. And of course, it's way premature, in fact, probably not all that useful to talk about rate cuts. But we've got the momentum there that the RBA probably thinks that the current cash rate at 4.35% is restrictive enough to keep the economy slowing, which it needs to do, which will probably see the unemployment rate approach 4.8%, possibly 5% in a bit of an overshoot if we were to see that. And that because of that, inflation returns to the target, the 2.5% level, which is the midpoint of the target. And just by the way, the RBA forecasts, and of course the forecasts are very volatile and they're probably going to be wrong. That's not a criticism, it's just a statement of fact. But as the forecasts stand, the RBA has actually got the inflation rate going below the midpoint of its target within about 18 months with current interest rate settings. That's a really interesting thing. Now, in terms of the economy, the other hot topic is housing, house prices. They are now falling pretty much across the country. A few months ago, it was really only Sydney, Melbourne and Canberra. Now we've got the other previously boom cities starting to join in. But the falls are fairly modest at this stage. Sydney and Melbourne are now down approximately 5% from their peak levels. The other cities have just sort of tilted into negative territory. And the big question is, what's it mean? Now, curiously, I think that the decline in house prices will actually have different effects on the economy. Clearly, they're negative for household wealth. But in terms of dwelling construction, if we find out that builders are now confronting this position where the current vacant block of land is not going to be profitable to build upon because they're worried that the future selling price will be 5 or 10% lower as house prices continue to fall, then they'll postpone that decision to build it. Pretty obviously that's going to be the situation. Now, if that happens, then of course new supply of dwellings, which of course is such a critical element of the housing affordability, housing availability issue, actually just sort of becomes a little bit less favourable for new supply as construction levels are postponed. So it's a sort of a perverse thing that you get from house prices falling. And in fact, that's what the stabilising point is. So to drill it all down on house prices, look, I think the peak to trough point for nationwide house prices will still be in that order of 7, 8, 9%, something like that. Similar to the sort of declines that we've seen in previous downturns, and the economy survived those in good shape. And that the position on a pullback in new supply because of the construction downturn, ongoing demand because immigration is still relatively high. Obviously, we're waiting to see what Tony Burke, the immigration minister, says in terms of any further scaling back in net migration. But the supply and demand dynamics are still there. We've got investors that are clearly pulling out of the market because of the tax changes, but it appears as though first home buyers are stepping into the market because of the improved affordability, wages still increasing, house prices down, and access to that 5% deposit scheme. For all its warts and all, it's actually encouraging first home buyers to step into the market. They're the ones that are likely to provide a bit of support for the economy. So for the here and now, the key points are the economy is slowing. Inflation has topped out. It's still too high, but it's pointing in the right direction right now. Unemployment rates going up. House prices still have some further downside over the short to medium term, but it's not going to be a crash. And that the RBA, to my reading of their forecasts, and not just what the RBA Governor Michelle Bullock said, is that interest rates are on hold, probably on hold through to the end of 2026. We'll kick off 2027 with a really interesting set of dynamics for the economy. The economy will have been weaker by then. The unemployment rate will be even higher by then. And the big question on whether the next move is up or down is what happens to inflation. If we get that inflation number still ticking lower towards 3 to below 3%, I'm not prepared to forecast it just yet, but the door is open, let's say, that the next move in rates is down. I think it's a 50-50 bet which way rates go next. Thanks very much. Look forward to chatting to all you wonderful Zagga customers again at the next opportunity. Thanks for listening. Bye-bye.